Okay, we got a cool panel. I'm excited about this next one. It's going to be awesome. It's called The Fed versus the Financial System, or as I like to say, the tyrants versus the free people. Anybody know what kind of car people at the Federal Reserve drive? Fiat. And anybody know what kind of medicine you take if you're going to sue the Fed? Sudafed. So this is going to be a great panel. It's all about one of the main themes of this conference, freedom of the people versus the centralized bureaucrats in fancy offices paid for by money they stole from the people. So we've got a wonderful panel, Fed versus financial system. Ram Ahluwalia, the CEO of Lumida. Mark Connors, head of research at 3IQ. Caitlin Long, who's an old friend of mine, American Banker Innovator of the Year nominee and CEO of Custodia Bank. And Dylan LeClair, head of market research at Bitcoin Magazine. Thank you, folks. Let's give them a big hand.
Check, 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 check.
Woo-woo.
Hey guys, thanks for coming. Thanks for being here. Exciting times, Bitcoin 2023. For anyone that's a first Bitcoin conference, welcome. We got a great panel lined up today. Fed versus the financial system. Notice how it's not Fed and the financial system. It's Fed versus the financial system. So before we begin, I'm just going to let all the panelists kind of give themselves a little bit of an intro about their careers, their background, and why they're very, very much experts in this field. Caitlin.
TradFi to Bitcoin, been in Bitcoin for roughly 10 years, and I guess I'm taking some Sudafed.
Well played, well played. Mark Connors, TradFi obviously a little longer, less recently into Bitcoin, ergo the suit, so I'm migrating to orange sneakers eventually. Currently I'm head of research at a digital asset manager, 3IQ, who pioneered the first spot Bitcoin fund and ETF in North America.
Hi, Ram Ahluwalia. I am the leader of Lumida. We're a private wealth advisor, provide tax and estate investment management, covering alternatives and Bitcoin. Prior to this, I was the CEO of the crypto business at Cross River, which has helped a number of institutions access crypto. We stand for decentralization and censorship resistance.
Cool. So I guess to start it off, here we are, 2023. We're almost 15 years post Great Financial Crisis, 3 years post money printer go burr, QE infinity. Now we're just basically on the tail end of the fastest rate tightening cycle ever. How did we get here? Let's just start from square one. Caitlin, you want to start, or maybe we hand it to Mark?
Sure. I think when we were talking backstage, we said what happened in March is part of a symptom. So the Fed today has continued a consolidation in the banking system that started with the S&Ls being rolled up. People's Bank was a small bank in my community. My dad was on it. They lent to people that they knew in the community. That got bought by First Union, by Bank America. So that's happening. Then the global financial crisis occurred because those consolidated banks screwed the pooch, they over-levered and they were going to fail. So the sovereign took up that credit risk. The roll-up continued. What's happening today, and we had in March, is now the Fed is absorbing more banks and consolidating. So this is just a multi-decade roll-up. But Caitlin is on the ground in what's an alternative, almost like a rollback to solving where we are in a fragile system.
Caitlin, you want to touch on your recent experience with the Fed and what you're doing?
Well, I'll start by saying, as a hardcore Bitcoiner, why on earth would a hardcore Bitcoiner start a bank? And the answer is that I don't think we're ready for hyper-Bitcoinization anytime soon. And I don't want the traditional financial system to melt down. I don't want to live in that world. And I would rather have a world where the two financial systems are developing and have connectivity that each one doesn't blow up the other. And unfortunately, we saw that there are arguments to be had that each one blew up the other this past year in 2022, where we saw the traditional banking model was not ready for this, and I'm specifically talking about Silvergate and Signature, not ready for how fast deposits could move from the digital asset industry. And I was looking at one of the banks. I started warning about this in 2020. If you go back to my Cato Monetary Institute Monetary Conference keynote, I started warning about liquidity risks among the stablecoin issuers. And one of the two banks, the two big banks that was banking this industry, had stablecoin deposits, and they had less cash reserves than the stablecoin deposits. And the thing that was worrying me was a little different than what actually happened. What actually happened was just a good old-fashioned bank run, but the fear that I had was that this is new technology, and especially looking back a couple years ago, stablecoins were relatively small and took off very fast, and for a bank that was holding stablecoin reserves to do the traditional borrow short-term and lend long-term maturity transformation was a recipe for a bank run. And I was behind the scenes warning folks, like, this is not gonna end well. And so I think there's an argument that crypto did cause a faster bank run at those banks, but there's also a big argument that the debanking that happened in traditional banks of this industry has caused this industry a lot of problems. So the goal that we set out to achieve of creating connectivity in a safe and sound way so that the two systems don't cause problems for each other has been the exact opposite. Now, the funny thing is, though, as we were talking about behind stage, I think this has all been a gigantic advertisement for Bitcoin, and it's not a shock that Bitcoin is up in the face of what's happened in the traditional banking system.
Ryan, you want to chime in?
Just to add to that, so how did we get here? In many ways, we have these banking issues because of the regulatory and Federal Reserve reaction to the 2008 crisis. And that reaction was to encourage banks to own what were called high quality liquid assets, HQLA, and that consists of treasuries and mortgage-backed securities that are guaranteed by the United States. So the regulators want to take credit risk out of the banking system, and banks have to make money, so what you do is you take interest rate risk. And of course, combined with quantitative easing and ultra low rates, you had banks, including the Federal Reserve, buying trillions of dollars of these securities. Then of course, when COVID happened, you had a ramp up in the quantitative easing and $2.1 trillion in COVID stimulus, stimmy checks. The combination of those two led to an increase in inflation, which the Fed initially perceived as transitory, which was incorrect. Fed starts raising rates, and when you raise the interest rates, then the price of the bond drops, meaning if you've got a mortgage, like at a 2.5% interest, and you own that as a bank, and now the interest rate's 5%, the value of that mortgage drops in half. And that's what's created these unrealized losses on the bank balance sheet. When there's a bank run due to a loss of confidence, then those unrealized losses turns into realized losses, and that's the issue we have today. So it really is a regulatory reaction to the 2008 crisis. Like Caitlin, I believe there's an opportunity for Bitcoin and banks to work together. The banks can provide distribution and provide access and provide convenience and payments to enable the next billion users get on board, with digital assets and Bitcoin.
So it seems like when I look at this and I look at just the history of these boom bust cycles in the U.S. economy, the tech bubble in 2000, the great financial crisis, the everything bubble that we had 2020, or I guess post 2020, 2021, it seems like the Fed is the primary engineer of these bubbles, and they're also subsequently they engineer the busts. And some may say that's just market psychology, but it seems like they are the primary driver here. And we were talking backstage. In 2012, you see Jerome Powell, before he's Fed chair, he says, hey guys, well, looks like we're engineering a duration bubble, meaning that when a 30-year bond is priced at 1%, when the cost of capital over 3 decades is priced at 1% annually, well, and inflation's at 2%, well, money's essentially free, and it's maybe not even free. You're getting paid to take on this in real terms. The cost of capital in real terms is negative. So what's the price of an asset when the cost of capital is negative, and it really doesn't compute, right? It's infinite. So
Correct.
So equities go up only, VC goes up only, private equity goes up only, and now in the face of decades high inflation, that's all going bust, right? And so there's a couple things. It's one, they're the primary engineer of this, and two, when you look at the banking crisis, or these banks collapsing, shuttering in record fashion, record time, are treasuries truly risk-free as they're kind of weighted in this capital or regulatory framework? Like, is this a failure of the Federal Reserve, or is it the failure of the risk managers at these banks?
Well, it's both, right? Because, I mean, if fundamentally the traditional banking model is unstable, the world it's always been that way, as long as we've had fiat banking and traditional fractional reserve banking. It's a fundamentally unstable business model. However, the world seems to be waking up to that now. And what I think has surprised the regulators is how fast the bank runs can happen. How can we know that for sure? The week before Silicon Valley Bank's bank run, Jay Powell testified to the Senate that the banking system was well capitalized, liquid, and sound, were the phrases that he used, something like that. The morning of the Silicon Valley Bank run, the head of supervision at the Fed, Barr, bragged in his anti-crypto speech that Fed-supervised banks don't have bank runs because they're subject to prudential supervision, as the Silicon Valley Bank run was happening. Okay, so and then actually there was a really interesting testimony that yesterday where it was somebody from the American Enterprise Institute who went back and looked at the November 2022 financial report to Congress that talked about how safe and how liquid the banking system was. So they did not see this coming. They should have. This is very basic bread and butter stuff. When interest rates go up, obviously the financial investments that you bought, if you bought long duration investments, are going to go down in value. So now what has the Fed done? It's playing a three-card Monte reaction to this by creating this BTFP facility where they're buying US Treasury bonds at par, even though on a mark-to-market basis they might be only worth 70 cents right now because interest rates have gone up so much. So it's an accounting trick. It just puts liquidity back into the system that they just tried to take back out. So it's going in one way, coming out the other.
Rob, do you want to explain BTFP, the Bank Term Funding Program, for people that
I just want to add to that, and that's exactly right on. So the Wall Street Journal reported in November that Silicon Valley Bank had negative equity, meaning if you took those unrealized losses because interest rates went up, then they would have negative equity. It was a known issue. The Federal Reserve, by the way, also has unrealized losses of about $1 trillion. And I have an analysis on Twitter showing that by the end of the year, they'll have negative equity as well. These are known concepts. This is not a controversial statement. It's been reported also by Barron's and other institutions. So to your point, it was a failure of supervision, also a failure of management, no question.
Yeah.
Absolutely a failure of management. It was grossly negligent management. But Signature Bank's another one. The Signature Bank had a Camel's rating of 3. So it's like a 1 to 5 bank report card you get. It's private, only the regulators know it. And 5 means that your bank is about to be seized or it will fail, and 1 means that you're in good standing. So the regulators really were not focused on these issues. And this is, to your other point, Caitlin, all banks engage in duration mismatch, meaning all banks are borrowing short and lending long. All banks are doing a form of a carry trade. And that fractional reserve banking only works when you have a sovereign that provides 2 things. One is deposit insurance to guard against bank runs. And the second is the ability to liquefy a bank's balance sheet. And that, to your point, Dylan, is a bank term funding program. And those models are now being challenged. Deposit insurance isn't enough. The bank term funding program can't liquefy First Republic's bank because it only creates liquidity for treasuries and mortgage-backed securities, which are issued by the federal government.
Mark, when we were in the back, we were talking about your history as a risk manager, overseeing various hedge funds. You had a very interesting comment on what you would say to the Fed if you were managing or overseeing their book.
Would have closed the book down.
You'd wind it down.
Liquidity, leverage, and concentration, they would have not passed muster. So there's one hedge fund, one of the top two out there, that has this person called the Hammer. And they send out a notice at 8 o'clock about taking down concentration. If it's not taken down, they liquidate the book by 8:30 pre-open. So that book would have been hammered. And the point about that Ron was just talking about the BTFP and about how this was sort of hiding in plain sight. It's like these conferences are wonderful, and thanks for having us, because it gives us the time to step away and really say, what's loud, what's there to focus on? And we're here to tell you that the Federal Reserve System and our banking system is fragile.
Yes.
It's become more fragile over time, and we want you to get curious about alternatives. And as Caitlin said, Bitcoin is still in its nascence. It is a more sound decentralized, and for your own purposes, the inflation rate and the money printing can only go one way. They have two options: keep adding to the money supply, or break the banking system and have a default. Two options. And so I'll lead a framework with you, which I think you'll hear more about over time. The Federal Reserve does not have two mandates. They say they have price stability and full employment. Well, people are backing out of the employment system, so let's talk about that later. But they have a third one, and it's financial stability, market stability, and they're failing at that. That's a new mandate that Volcker didn't have. So Powell Volcker, not the right story. Powell is standing on a single pogo stick, trying to keep things together. And March was an example about what will happen and happen again. So it's not a great system, a great story, but I just want to go out there. When we talk next year, let's talk about how the system is now at not at 4,500 banks, but probably at 3,500 banks. And those 3,500 banks, 8 of them have 50% of the deposits. It's fragile. It's not serving the people. That's why it's Fed versus the financial system. It's not serving us anymore, unfortunately.
So I have a question for you guys, and I didn't go over this behind the stage. I'm just going to spring this upon you. You know, as a casual onlooker to this banking system, this insured banking system, right? You know, the FDIC insurance, $250,000 per person per account. How does $200 billion of insurance insure $10 trillion of bank deposits?
Oh, it's not even 200 billion. The FDIC insurance fund net of the failures is somewhere around 85 billion. It's below 90 billion.
Yeah, it's like 100 billion-ish, I want to say, but yeah.
And then, but that was before First Republic, right, which was another 13, right? So it's, and of course they're playing a little bit of a shell game with that because of the way they did the loan guarantees and things like that, right? So it's not like the loss wasn't necessarily crystallized. We're not going to know for a couple of years. But your point is well taken. Most people don't do that math, right? For years, the moment you do the math, you quickly realize, well, if the insurance fund doesn't have the cash to pay out losses, and it can borrow from the U.S. Treasury, but then there's this pesky little thing called the debt ceiling, and in a financial crisis, Congress would probably just jettison the debt ceiling, but there goes the value of the dollar, right? I mean, you start playing it out in your mind, realizing, all right, this FDIC insured limit thing is a bit of a shell game. It's those of us with a financial background would recognize it as it's just the senior layers of a CDO. All you're doing is just pooling risk, but there's not really that much equity behind it. And you're just making it seem like it's a higher rated entity than it is.
So if all these banks are running a fractional reserve, I'm not going to call it a Ponzi, but maybe you could look at it like that. Why doesn't someone just open a fully reserved bank? Why doesn't this happen?
Why? Yeah. Anyone here? Anybody?
I have a good idea.
Well, we tried. By the way, it's far from over. When I was just in Jackson.
Can you give some context for anyone that doesn't know your background?
So Custodia Bank, actually, back up. The state of Wyoming started working with the Fed in 2019, so 4 years ago, on a new type of bank charter that would specialize in serving the digital asset industry. This is a new asset class. I don't really think of it as an asset class. I think of it as more of a technology, but it's both. And so it didn't fit within the traditional buckets of, is it money, is it securities, is it a commodity? If it's not those things, what is it? So Wyoming started by saying, well, it's property, so if it's stolen, then theft laws apply. And then it started to define what are the commercial rights and obligations of parties to a transaction. This is Trace Mayer, one of the OG Bitcoiners. He's an attorney and an accountant by background, and he wanted to close off future attack vectors on Bitcoin, one of which would be the court system, not recognizing what it is. So let's make it backwards compatible with the legal system by having it defined in property and commercial law. And then the next piece is Wyoming, in response to the last crypto winter. Some of us have been through 3 crypto winters. This is our 3rd. And you know, it always feels awful, but the industry always comes back with a halvening cycle, and I know it's going to, well, I'm fairly certain it's going to again, for very fundamental reasons. But here's the point. Wyoming wanted to respond to the entrepreneurs who in 2017 en masse lost their businesses because they lost their bank accounts. And in the United States, you're not a business if you don't have a bank account. Why? Because federal law requires you to remit your payroll withholding taxes to the IRS through your bank. Okay, so a lot of valid entrepreneurs, legitimate non-scammers in the 2017, well, in that 2016 cycle, in 2017 lost their bank accounts, and so Wyoming set about to create a new type of charter. We collectively in Wyoming knew the FDIC was not going to insure this. And by the way, I don't think the FDIC should insure this, because the FDIC is actually the core of the financial system. You don't want.
You got some clause in that one.
Yeah, I mean, but it's logical, right? You don't want this fast-moving stuff to be combined with the old horse and buggy technology systems on which the traditional financial system runs. This is part of the reason why we had the failures of Silvergate and Signature. The settlement cycles are so fast in crypto, and the settlement cycles, let's face it, in traditional finance, it's all still, for the most part, batch processed overnight. Okay, and so when you put those two things together, you could have an intraday bank run so fast and the bank wouldn't even know it. So I just gave a really long-winded answer to what got to the whole idea of, if it's going to be an uninsured bank, then it cannot lend, and therefore non-lending bank. Well, a lot of us in this world, because we recognize that the financial system is fundamentally fragile, Bitcoin is fundamentally anti-fragile. Well, if we're going to put the two together in a safe and sound way, then the bank can't lend. Yeah. Not rocket science.
Love it. And I think the point goes over a lot of people's heads that, like people will say, oh, well, self-custody fixes this, and that's great. You or I can have Bitcoin on our cold card, but for an institution, you can't just send your funds to a wallet and call it a day. There's like a whole regulatory process and framework. And so what you're doing at Custodia is attempting to fix that, but you've come across some hurdles in the form of the Fed. Am I wrong?
Well, I would say it's really interesting because we don't know the precise. We don't know exactly what happened to us. On January 27th, the Fed denied us. It was absolutely a blindsided event. Because we were making a lot of progress and had good reason to believe that we were going to be approved by the Fed. And then all of a sudden, boom, 180 degrees, came down on us like a ton of bricks, used the press to try to pressure us to withdraw. They didn't know who they were up against. We weren't going to withdraw, but we didn't withdraw, and then they hit us with a ton of bricks and disparaged us and threw all kinds of stuff out there that actually turned their own policies on their heads. So for example, the President's Working Group, of which the Fed is one of the voting members, had originally said that only insured depository institutions should issue stablecoins. Right. But what they said in the Custodia order they did a 180 on that as well, and they said essentially that banks can't issue stable coins under Glass-Steagall. They don't want banks handling open, public, permissionless networks. By the way, they didn't say open, public, permissionless blockchains. They said open, public, permissionless networks. And again, TCP/IP is an open, public, permissionless network. Do they not want the banks to use the internet? At first, I kind of thought, no, this is just sloppy drafting. But now, given everything that's happened, I'm not so sure. I think they do want to push the traditional banking world back into analog paper checks. We were talking backstage. You've never written a paper check, right? But they have better control over the stability of the system if everything's in analog form. They don't like technology. So. Yeah, but we're not done, by the way. Stay tuned, because one of the reasons why a bank would want to be involved in Bitcoin in the first place is, as you allude, there are certain types of businesses like investment companies, registered investment advisors, corporate treasurers, other types of fiduciaries that have to, by law, segregate the custody of the assets from the management of the assets. So I guess I'll go ahead and break a little news here. Custodia turned in its 60-day advance notice to the Wyoming Division of Banking in April for Bitcoin custody. So we will very shortly be in the Bitcoin custody market. Thank you.
You guys have anything to add?
Yeah, no, if we take a step back and say, how do we fix the banks? It's an important question. It's time to start thinking longer term instead of playing whack-a-mole with every other week. It seems like there's a bank failure. It's starting to look like an American tradition now, and that needs to be addressed. So there's 6 banks in the United States that have 50% of deposits, and there's 4,000 banks overall. Most of those banks are small community banks. And to the earlier point, most of these banks are built on antiquated technology. They're using databases instead of cryptographically secure blockchain to manage assets. They work Monday through Friday, 9 to 5 p.m. instead of 24/7 payments. They use these old software systems called bank core processing systems, and mistakes happen. There was a time where the Fed wire system went down. It's absurd, it doesn't make any sense. And so here's how you start to fix it. You need to introduce competition. That's going to come through 2 ways. One are de novo charters, like what Caitlin is looking to do, have a bank charter and allow new banks with private capital to be formed to create competition. That's one. The second thing is you have to enable private capital. That can include technology firms, private equity firms, venture capital firms, or entrepreneurs to own, control, or start banks. So it's illegal for Apple to run a bank, or Google to run a bank, or to bail out a bank, or save Silicon Valley Bank. So this is why you only see banks buy other banks. Meanwhile, the banking system is going through a deposit drawdown. The banking system has lost 6% of its deposits. They're going out there to money market funds. And so the pool is getting smaller, and you need outside capital that can inject capital, inject technology. So you might have seen like the Apple Bank product that was launched. Apple has 150 million credit cards on file. Apple has more customers than JP Morgan. JP Morgan and the big banks are afraid of technology competition coming. But Apple has to work with Goldman Sachs to take in deposits. So Goldman Sachs is the bank on the back end, and Apple runs the front end. And that's just regulatory arbitrage. That's just a form of rent seeking. And what we really need to do is encourage competition, add outside capital, add competition, add innovation, add blockchain, add Bitcoin to strengthen, renew, and revitalize the banking system.
Love it. All right, I think we're going to pivot a bit. We're going to go a little bit more macro, and then we're going to wrap it up with how this magic internet money can play into this crazy world that we're navigating. So here we are in 2023. Like we said, there's a tech bubble, great financial crisis, housing bubble, the everything bubble, and following 2022, treasuries, long-end treasuries had their worst year in, at one point it was recorded history. I think it might have not been to finish the year. But bonds down 20%, it's relatively unprecedented. Doesn't fit into anyone's risk model. 40 years of negative stock bond correlation. When equities fall, bonds rally. That's built into every risk manager's process. And when that doesn't occur, doesn't play out, a lot of people start to panic. So So, inflation is still pretty elevated relative to the last 20 years or so of disinflation, post-globalization. What does the investment landscape framework look like? And Mark, I'm gonna come to you first.
Look at me, I was jumping on that. Like, can I do that one?
But like, what does potentially the next 10 years look like if this risk parity 60-40 model is broken, or at least temporarily is no longer in play?
Well, pulling on what Caitlin's doing, what Ram just said about Apple Bank being more customers than JP Morgan, but still bound by that antiquated fiat system. People are leaving the US. This is a total own goal, guys. This is terrible for the United States.
Yeah.
People are going to leave and continue to leave. So back to risk management. The correlation between the S&P and 10-year has been my go-to bellwether regime shift since 2007. It's been phenomenal in looking at it. Later, because I'm not that sharp, I decided to see what it looked like in Europe. And then I was like, wow, very similar, the Bund versus the DAX, where it was positive correlation. And then when March 07 hit, the mortgage crisis, before the banking crisis, reversed it. And there was a negative correlation to the degree we've never seen in the history of the 10-year since 1962. That negative correlation means there's polarity driven by one major animal, the central banks. So that started in 07, and they've really never released their grip. So again, I'm not the sharpest tool in the shed. It took me a couple years later to go look at Japan. And then I was like, wait a minute, Japan started in 92. They are the cautionary tale. So when we talk about what's going to happen, if we stay in this somnolent, kick the can down the road, high debt, low growth, steal from the next generation, people are going to leave. And you're going to end up like Japan, where there's no growth, people are living in little boxes, and no one's getting married or having kids. Like, it's not a great situation. So what do we need? We need to change it. We need to change the technology, change the legislation. And, our firm, I'm a US citizen, I'm working for a Canadian firm because they solved the spot Bitcoin. They went after and worked with the regulator. So I'm a guy who went off overseas across the St. Lawrence River to Canada. So what I think's happening is overseas, but now you always got to have a good part. The work we've done, and we're messaging it with anybody and everybody, open source, it's on our website. Bitcoin has convexity for your investment portfolio. Adding 1 to 3% Bitcoin adds 1,200 basis points over 5 years, looking back, 75% over the last 10 years. So Bitcoin is also not just the foundational layer of money, it also can solve what's happening with the investment world of a very sloppy 10-year that is no longer an investment vehicle, but a tool of the Fed. So that's my thoughts. I know Ron's got something to say.
No, this is a great topic. Like 60-40 is dead, right? 60 is the equity, 40 is the bonds. We just exited this 14-year period of $9 trillion of quantitative easing and ultra low interest rates. Now we're going to go through the hangover period. And so we need a different approach, and Bitcoin can diversify portfolios. Say the other, take a look at what's worked and not worked. In COVID, you had the Zoom stocks and the Peloton stocks and the DoorDash and all the rest. All those stocks are now trading below their opening price. You had stocks that had price to sales ratios of 100. You had story stocks that were not valued on cash flows and fundamentals. That's going to change because now we're exiting this environment of negative real interest rates and transitioning to an environment, hopefully, that is more normal and positive real rates. We'll see what the Fed does. And that has different implications for how you allocate. And I'm actually very excited about distressed commercial real estate because it's a good balance with Bitcoin. Because just like in the post-2008 crisis, one of the things I was doing was buying distressed mortgages and single-family residential houses because it's a real asset. It's a hedge against inflation. I think inflation will be higher for longer. And it throws off cash flow, so it can fund your expenses and you can plan around that and enables one to hodl longer. So I'm excited about dislocation opportunities that we'll see in the years ahead. I think we'll get back to interest rates. Inflation, I expect, will be higher for longer. The last time we saw an unemployment rate this low was 1969, it's 3.4%. Guess what the stated inflation rate was? It was around 5%. Guess what the stated interest rate was? It was 5%, kind of where we are today. And the 70s, you had a lot of policy volatility around interest rates. Went up, went down, went up, went down. If that scenario unfolds for us, and there are a couple of different scenarios, we'll have to see how AI impacts productivity rates. We need a very different approach than the 60-40. I think alternative investments have an important role to play in that.
Caitlin, do you have anything to add, or?
I tend to stay out of the investment advice business, so I'll leave it to those guys.
Love it. Yeah, I think, and I continue to just hammer home this, when you're talking about the macro framework, the macro thesis, it's in a world where bonds, and you can say, well, technically, inflation, whether it's CPI or PCE, is a year-over-year metric that's backwards looking, and bond yields are forwards looking. Okay, I understand that, but we're coming off of a 4-decade-long period where the interest rate you received on long duration debt was higher, or even shorter duration, was higher than the inflation rate. So you got a real return on debt as an asset class, sovereign debt, corporate debt. And in 2021, 2022, that radically changed. And you can say that was, the COVID stimulus, that certainly played a role. You could say this is somewhat of a deglobalization effect, or more of a multipolar world order. But these are all big, potentially tectonic shifts. And if this regime that we're all playing a part in is over, what does that mean? And Bitcoin is this completely different world for a lot of people. But the thing that gets me excited is that sovereign debt, or debt as an asset class, it's so boring. Who wants to talk about bonds? But there's hundreds of trillions of dollars of capital that's priced off this. And so if the investment framework for debt as an asset class is wrong, right? In 2020, 5-year forward inflation expectations were 70 basis points, right? And well, that was wrong, right? But it's already very wrong. So everyone that held bonds, including the banks that all failed, got smoked. And so maybe this trend continues, maybe it doesn't. But I think what the real question is, what role does Bitcoin, this absolutely scarce monetary asset with a production cost, what role does this play in this environment where, again, sovereign debt to GDP is at 120% in the United States, and the United States is probably the best, as Greg Foss said, it's the cleanest shirt in the laundry basket, right? Europe's not any better, Japan's not any better, China has a debt problem and a demographics problem, so everybody's up to their eyeballs in debt, and they can't default. It's only fiat. So how do we get out of this? And there's not many people with answers other than, we'll just kick the can and print, right? So how do we think about this? And do all roads lead to Bitcoin, or are we just in our own little echo chamber here?
Satoshi gave humanity money that is not issued by anyone, and it's an insurance asset. It's an honest ledger. And ultimately, in human history, the money evolved to be whatever people recognized as an honest ledger. Everyone agrees that you want the fruits of your labor to be stored in a store of value that is fair to you. And that is not what fiat currency is. The subtlety is that people don't understand that the fiat currency system is through inflation subtly stealing their future purchasing power, and Bitcoin does not. It's an honest ledger, and people will vote with their feet to using it, and the more the central banks print, the more it's an advertisement for Bitcoin. I don't think it's a coincidence that Bitcoin is up a lot this year in the face of what's going on. I find it just awesome.
It's so different. First of all, it is an advertisement, Caitlin, and when you talk about the innovation of Satoshi Nakamoto, think about the U.S. Like, money's always gotten faster. We talk about coins, yapstones. Bretton Woods was really almost an alien. It was almost like the founding of the U.S. when we created our system here, in that they got 43 other countries to ship their gold to the bottom of Maiden Lane and said, trust us, we'll get this done. That was before the war was over. And then they issued for the first time a global certificate that everyone backed together. It was not like previous sovereign reserves, where they were the reserve. It was based on their gold. This was a communal effort, and it worked wonderfully for decades. But it was gone. Nixon blew it up. The point about this is that innovation was wonderful and unleashed decades of productivity globally. We need another one now, because forever, fiat was backed by force. You know, Lincoln created the Secret Service, I think 4 months before he was killed. The Secret Service was not created by Lincoln to protect him. It was created to protect the money. That's how important money is. He didn't care about his life. He knew without money that the United States was going to fold. So the Secret Service, money is protected by force, and it's right now, the force of it is disrupting our country. Back to risk management, it has created such volatility in the base layer. The money supply is so volatile that it's shrinking investment. You cannot invest into uncertainty. And volatility in investments is a definition of uncertainty. So where are we right now? We need to message. It's now up to us, not to point the finger at the Fed, but we have to figure out ways to make it more accessible, how to message it, how people can understand it, and then we need to fix our own plumbing to make it more.
Right
and
on.
I know you do deep dives on
No,
it.
this is great. I think there are hard choices ahead, right? The debt to GDP ratio is 125%, and no one's talking about entitlements, Social Security, Medicare, Medicaid, which is going to raise debt to GDP even higher. There are only 3 choices that can be made. Either you cut spending, that means addressing entitlements. No one wants to go there. You don't get elected if you discuss that. You raise taxes. I don't want to go there. And the third choice is you inflate. So I expect inflation will remain higher for longer. The can will kick down the road again. Bitcoin will benefit in that kind of environment. I'd also say that, you know, if you go back to the principles of the American Republic, they were premised on decentralization, checks and balances within Congress, bicameral, the judiciary branch. And the national banks didn't even emerge until the middle of the 19th century. I think we need to go back to the principles of decentralization, broaden access, and focus on education and messaging, the role of Bitcoin.
Love it. Well, we got a couple more minutes left, but maybe we use them, maybe we don't. But one of the funny things, whenever I have this conversation a lot, you know, what we just talked about for the last 10 minutes, you know, sound money and the need, and you know, what the next 10, 20 years look like in terms of the fiscal spending and the inflation. And it's like, well, sound money, right? And yeah, sound money. Well, gold. And I'm like, okay, great. Well, gold failed in 1933 when FDR confiscated it, and gold failed in 1971 when Nixon defaulted upon his IOU, and I always get the response, well, gold on a blockchain. And I'm like, wow, you invented a trust model, you reinvented it. And so I guess maybe we can end it there. Bitcoin as something where you don't trust anybody, verify it for yourself. It's a true engineering innovation, and I think it's not well understood broadly, and it's everyone's job here to educate the masses on what this means and to secure your own future. So appreciate everyone tuning in. It's been a fun panel. These are 3 great panelists, and enjoy the conference.
Thanks, Dylan.
Welcome back. I'm Pete Rizzo, editor of Bitcoin Magazine. We're here again at the Bitcoin Magazine live desk presented by Marathon at Bitcoin 2023. I'm joined by a new round of special guests. To my left, John Seth, Bitcoin skeptic. To his left, Joe Consorti, market analyst, the Bitcoin Layer. Last but not least, Daniel Prince, host of the Once Bitten podcast. So we just heard from the bankers, the institutions, some challengers looking to get into the market. We talked about the Federal Reserve, the COVID stimulus, inflation and the economy, and the consequences of free money. Joe, I'm going to kick it over to you. The Fed should have seen this coming. I think this was your quote backstage.
Absolutely. The Fed should have seen this coming, and really what they're doing right now is the same thing they were doing by being too late to the party with inflation. Now they're not even addressing the fact that bank failures are happening, and they're saying this is all fine, they're sweeping it under the rug, when in reality small banks are going to continue to go belly up. The problems are still present, and while large banks may be able to borrow from these emergency loan facilities that the Fed is creating, small banks will be unable to do so, and we're going to continue seeing this. And now the risks aren't towards inflation, but rather disinflation.
Daniel, I want to move it over you to your take. The Fed should have seen this coming. There were people there who were saying this might happen again. It's going to get worse. How different is this from 2008? Maybe set the stage.
Well, I want to come to something that Caitlin was talking about her bank not getting the license after doing all of that work that they requested. And there's a whole host of reasons for that. And this goes all the way back to the original Federal Reserve, the secret meeting in Jekyll Island, 1910, which we all know about. This is how the system has been set up. They are really gonna be meeting an absolute brick wall. And these bank failures is good for the Fed because that just completely monopolizes them. The less banks there are, the better. So go read The Secrets of the Federal Reserve by Eustace Mullins, and all of these little dots, they just fall into place.
John Seth, the skeptic here, you were saying you're a fan of the Federal Reserve?
Big fan of the Federal Reserve. Honestly, I don't know about all that stuff, but I will say, I think that when the markets are failing, when the markets are failing and prices are going down, for young people like us, that represents a great opportunity, and people our age should be piling into these assets and Bitcoin and whatever it is they can right now. Because honestly, I don't think that you're going to see prices like we're seeing, for generations. Honestly,
interesting. They talked also about inflation and Bitcoin positioned as an inflation hedge over the last few years, but obviously if you bought Bitcoin this time last year, Bitcoin 22 price $41,000. Do we still think this narrative is going to drive mainstream adoption, Daniel?
Are we going to have another post-conference dump? Because I'm here for it. Just stack sats.
You got to take a look at the block
clock. The T-shirt says. Stack sats.
I don't think we know what Bitcoin is for. I mean, I think we've said for many years that Bitcoin is a inflation hedge, and by we, I mean other people. But like Bitcoin is an inflation hedge. Maybe it is, maybe it's not. But we know that Bitcoin is something different than the world has ever seen. And whatever it is, like while it's highly correlated right now with traditional markets, I don't think it's going to be forever, and I don't know when or why it's going to break out, but it is a different asset than we've ever seen before. It does different things.
Joe. Well, Bitcoin, and thanks, Pete, thank you. John said, Bitcoin benefits directly from the monetary debasement that's going to come when the Fed has to amend the policy error it's creating right now, right? We have disinflation, economic deterioration, and perhaps an economic crisis on our hands, and we know cycle after cycle, it may not be a price inflation hedge, but sure as shooting, it is a monetary debasement hedge, so it is a money inflation hedge.
So it sounds like you're saying it's coming, the Fed is going to have to change, and that's when it's going to be good for Bitcoin, but it hasn't yet. Daniel?
Yeah, let's bring it. Let's bring the decoupling. It can't come quick enough.
Interesting. Okay, I want to flip it over to another topic that the panel talked about, which is how do we fix the situation? Can the Fed do anything about it? John Seth, your take?
I tend not to believe that we have much control as human beings over the market generally. The Fed has control over interest rates, and that's about it. And those are nominally effective for like short-term changes in the market. I don't think that the Fed can do much.
Joe?
Absolutely. I tend to agree with John Seth. There are a couple things they can do, but exactly as you were hearkening to, the Fed has a really limited tool set, right? They have the ability to manipulate front-end rates, and it really only influences the front end of the interest rate curve. It doesn't influence things like the long bond, like mortgages, right? So at the end of the day, the market's in control, and the market is screaming basically blue bloody murder right now that the Fed needs to stop their hiking. They need to pause here, and they need to allow their aggressive tightening to work its way through the system and ideally not cause an economic recession.
I want to change the script a little bit because we're kind of running out of time. Next panel on the main Nakamoto stage is going to be fighting the anti-crypto army. Elizabeth Warren coming in really hot. The Democrats in the United States coming out against crypto broadly, maybe not seeing Bitcoin specifically. Want to get reactions. What are you expecting from this panel? What do we want to see about this conversation?
A lot of complaining.
Yeah, fireworks.
I don't care that much what Congress says about Bitcoin. It's never been like a big thing for me. I think that ultimately Bitcoin, like we should watch Congress and every nation test what we've built here. It's supposed to be anti-fragile. I think we all have a question as to whether it is. And they can go ahead and attack it. They can do whatever they want.
Joe, what message do you want to see sent to D.C. today?
The message I want to send to DC is you need to be receptive to Bitcoin. At the end of the day, this is an asset that is monetizing. Eventually, it's going to usurp some of your favorite assets and equity indices, not just gold, but the $22 trillion US Treasury market one day. And it may be years off, it may be decades off, but at the end of the day, you're going to have to start being receptive to this thing because this asset isn't stopping monetizing.
And they have, every single one of them is going to have a Bitcoin Standard book on their desk, courtesy of Orange Pill app, courtesy of Saifedean, courtesy of Geyser Fund that have funded this project. The same's happening in Europe, same's happening in countries in Africa. So let's do this.